Well, that's correct, Tanya. Today's last hour for in India actually was more of a local factor, or local factors, I would say, compared to global factors. The world is trading mixed. Asia was good, Europe was flat with a negative bias, and Dow futures were all over the place, actually. So it was more local compared to what's happening in the rest of the world today. Look at how the market complexion is extremely fragile. So there's absolutely no confidence in the market, and slight sliver of any negativeness can hit the sentiment very hard. Just take, for example, PSU banks reversed the rally in today's session, led by the commentary coming in from SBI, indicating that the bad loan pressure, not only for the bank but for the sector, may just well continue in the coming quarters as well. That completely reversed sentiment. PSU banks, in fact, led the fall in today's session. Capital goods, real estate, all the financials, or I would say interest rate sensitive sectors were the ones which dragged the markets lower. Not only that, markets are technically perhaps set to revisit the recent low. It's not very far away, about 150 points on the Nifty from current levels, because it just managed to end above the 7,000 mark. And FII sell just continues. Another 1,000 crores sold in today's session, whereas DII buying was very little, just 500 crores. Perhaps a positive point is that index futures, where they've bought a good amount, almost 600 crores. But local cues are very negative, and the commentary from some of the large corporates like SBI dented sentiment badly today.
Okay, let's in fact keep that market discussion going, and joining in for that we've got three special guests. R. Sri Shankar of Prabhudas Leeladhar, Barclays, Henk Potts is here from London, and on the phone line we've got Gurraj Singh, who's a senior global macro portfolio manager, joining in from New York. Gentlemen, all three of you, thanks so much for taking time out for us. Sri, let me begin by asking you, what did you make of the market moves today? Despite some pretty decent global cues, we've ended with a fair amount of weakness. When do you suppose we're going to see some sort of stability return to our markets, and when is it going to get easier to really call this market?
I do not think that it is going to stabilize quite easily. We are bound to see some huge volatility in the market. The huge swings. Yesterday you had this closer to 600 points rally, and probably today you're seeing the exact opposite of what you saw yesterday. So I think you need to budget in for that, anticipate that. And while yesterday we saw domestic institutions buying closer to 2,000 crores, FAI still sustained, numbers still is negative. So unless that selling gets reduced a bit, I don't think that you're going to see a reversal in the market conditions near term.
Gurraj, what are your thoughts on global market volatility? In fact, just 4 hours back, the Dow futures, in fact, the instrument where India draws a lot of cues from, and all the BTST trades, or whether to carry positions overnight or not, depending on how Dow futures are indicating, was actually negative 20 points. Just an hour back, it was higher by almost 200 points, and right now when the US markets have opened, they've given up gains. So the volatility in Dow futures has become quite elevated last couple of weeks. What are your thoughts on that, since you track volatility very closely?
Right. It's really since the beginning of the year, the primary drivers, for the U.S. market and in turn the rest of the market have been the degree of the sell-off in oil and its impact on financial institutions and the various countries, and also the developments in China. More recently, because of the incredible volatility in the Chinese market, the U.S. market is taking its cue from there, and any changes in its foreign exchange reserve position, as well as shifts in monetary and fiscal policy, they are having a great impact over here. The U.S. investors, the prism through which they look at this situation is, how is it going to impact the Federal Reserve's decision to continue to raise interest rates? And the market originally was pricing in about 4 rate increases for the rest of the year, and now it's pared it back to about 2 rate increases. And these type of developments are causing quite a bit of volatility in the U.S. market, and I have no reason to believe that won't change anytime in the future, particularly because the situation in China is very liquid and constantly changing, and that's going to impact the U.S. market and the monetary policy here for weeks to months to come.
Hank, the other development of the day is that Saudi Arabia, Qatar, Venezuela and Russia have agreed to freeze production levels at the current level, which is January levels, and also record levels. No production cut has been agreed upon. And the agreement is also contingent on other producers taking the similar course of action. What are your thoughts on what has been agreed upon so far?
Well, what we know is that OPEC has really struggled to come up with an agreement when it comes to cutting production levels. It's one of the reasons why we've seen oil prices fall quite substantially. So it still remains to be seen whether we'll actually get to the point where they will be cutting production levels. Of course, many of the conspiracy theorists will tell you what OPEC have been trying to do over the course of the past few years to keep oil prices low, maintain their market share to drive the shale producers in the United States out of business. So it's hard to see exactly what the strategy is still from OPEC playing out. Remember, they've held on to this elevated levels of production even though prices have fallen quite substantially. I think when you look at the oil price though, it's been driven down by a number of factors, and it's not simply OPEC these days that determines the oil price. In the short term, oil price has been driven down by lower levels of economic activity. The high levels of inventory that we've seen in the United States almost got to the point one stage where they were struggling for storage facilities for the excess supply. And of course, Iranian oil coming back onto the market. Another 1 million barrels of oil set to hit the oversupplied market. But structural changes, I think, are important as well. We've seen a significant pickup in some of the most fragile producing nations within OPEC. But alongside that, shale producers, the change in technology has increased supply in the United States. And demand from the likes of China, as demand growth has fallen quite substantially as well. So I think when you put that together, it tells you even if we were to see a cut in production levels coming through from OPEC, we're still looking at lower oil prices for a prolonged period of time.
Shri, let's talk about, this tight correlation that we've seen between oil and equity markets. Do you believe that if we do at some part, or rather, at some time in this year, see crude prices stabilize somewhat, that in turn will perhaps take away some part of this volatility that we are seeing?
I do not think that equity markets are taking a cue from what crude is doing today. But probably equity markets across the globe is taking a cue from what's happening around the world, and how strong is going to be the US growth for calendar year 2016, and so is the case for the global growth for calendar year 2016. So as you feel headwinds, challenges to that growth numbers, what you anticipate is that problem is going to spread across, to Europe, to China. China will have even a tougher time, and that will probably result in much more problems coming around in the market. If there is a devaluation of Chinese currency as well, it will lead further into a competitive devaluation among the Asian nations. So the growth is going to be a serious question for a larger part of the economies around the globe, or the pace of growth, where everybody will have to budget probably downwards their estimates. And that's going to be the biggest challenge. So market is taking a cue of it, in my personal view, even now itself.
Gurraj, I want you to sort of respond to that. Would you not agree that we've seen equity markets and oil prices sort of move in lockstep? And, in your earlier answer, you were talking about how these volatile times are here to stay. Then how are global funds especially sort of positioning themselves? Are they waiting by the side? Is cash king right now?
In general, the correlation between equities and oil, shifts from time to time, and more recently there's been a higher degree of correlation because for a few reasons. The primary reason being there's been a tremendous uptake of high yield related debt among oil companies, particularly shale producers in the U.S. And as oil prices fell quite substantially, it's made it very difficult for those firms to maintain their interest payments on their debt, and therefore impact the financial institutions which underwrote that debt. And that's a situation which is not going to go away anytime soon. Therefore, that degree of volatility is going to stay in the market. The other impact is that a low oil price in general reduces the number of dollars worldwide that get recycled into U.S. assets, because exporters earn fewer dollars. And Therefore, in some cases, exporters, particularly among the OPEC nations, are probably looking at liquidating U.S. assets and or devaluing their currencies, to increase their own budgetary situation. And those particular type of developments, in part, are priced in the market, but to a large degree they aren't, or particularly the Saudi situation. And so that degree of uncertainty is going to create an elevated level of volatility relative to an environment in which there's few major developments going on, and that's very separate from China, and that's another separate and distinct situation, which is likely to keep volatility elevated as global funds seek to try to navigate a situation in where there's uncertainty with respect to growth and also uncertainty with respect to U.S. monetary policy, which impacts the rest of the world.
Gurraj, where you're sitting out there in New York, when you interact with portfolio managers in your circle, within your community,
sure.
What is the sense you gather as far as their positioning towards emerging markets is concerned? Data clearly shows last couple of weeks and months that a lot of money has been pulled out. But is there willingness to look at that asset class at all? Because US markets too, after a 7-year run, uninterrupted run, have corrected 10% and have become attractive according to some managers.
Right, absolutely. My colleagues, the prism through which they're looking at the situation is in part the trajectory of the U.S. dollar, which is also driven by U.S. monetary policy relative to the rest of the world. And as there becomes greater clarity whether the dollar is going to continue to strengthen in light of the Chinese situation, the European situation, the Japanese situation, they're likely to wait on increasing investment to emerging markets. But as that change occurs, which I believe will occur later this year, after there's much greater clarity with respect to the weakness in Europe and China probably devalues in a very substantial way. At that point, I expect a tremendous amount of capital to flow right back into emerging markets, because it'll become a transition point, for the entire world as the U.S. monetary policy has shifted in light of what's happened in the rest of the world, and capital will be reallocated to emerging markets. The other thing is, as the uncertainty with respect to what's happening in monetary and fiscal policy worldwide increases, I've seen increased number of my colleagues allocate capital to gold and silver, both at the commodity level as well as the individual equities, and in part it's because this particular asset class tends to do quite well in times of uncertainty with respect to confidence in monetary and fiscal policy, and that seems to be increasing as the weeks and months come.
Right. Henk, let me have, you can have the last word. And the one thing in the last couple of days which has been observed is the increasing commentary coming in from central banks, willingness for further stimulus. Some of them have committed money as well. That seemed to be fueling stock markets, for a very brief period, and markets have been cooling off after that. How long do you think will it take for central banks to rescue in a rescue move of announcing stimulus, but actually there's very little trickling down into the real economy?
Well, I think when you look at the work done by central banks, it's still very important. The recovery in certain regions of the global economy still remains very fragile. So if you look at Europe, for example, as a classic picture there taking place, where we've seen the European Central Bank cut interest rates down to historically low levels. They've introduced a targeted long-term refinancing operation. Negative interest rates, of course, charging banks that keep their money at the central bank to encourage them to lend. These aggressive moves, that's recently followed by Japan as well. So there are areas in the global economy that still remain vulnerable. I think the outlook in general still could be seen as quite positive. If you look at the International Monetary Fund's latest predictions, still talking about global growth around 3.4% during the course of this year. Stronger performance coming through from some of the developed nations, particularly the United States, helping out in terms of that economic picture. We'd expect growth to accelerate as you look out to 2017. So I think there is a role to be played by central banks in supporting the recovery. I don't think we're simply reliant from a global perspective on central banks, but as I say, certain parts require that. But in general terms, there's lots of parts of the world that still look very positive indeed and will continue to grow. And at some point, we'll start to see the normalisation of policy in those areas.
All right, gentlemen, Hank, Gurraj and Shri, all three of you, thanks so much for taking time out for us here on Smart Markets. Let's, in fact, take a breather from all the market chatter.